Energy was clearly the most under pressure really for the past few years in the leverage space. And I think that defaults were already pretty widely anticipated by the market this year, even when oil was in the, call it, mid-60s area earlier in the year. And with oil prices falling as much as they have, and also the natural gas story becoming more and more weak, seemingly by the minute, I think energy defaults are pretty much a foregone conclusion at this point. And now the question is, does energy within the leveraged finance universe, is it contagion into the rest of the market? Is it really signaling that we are actually about to head into a real default cycle, which we haven't seen for quite some time in high yield?
You know, ironically, Winnie, we have rates so low that you'd think now it would be a bonanza for companies who were trying to kind of improve their balance sheets. But if you can't get access to the markets because people are worried about the economy, it doesn't matter. It makes me wonder about the efficacy of again, Fed rate cuts. But let me ask you, because as you said, energy has been a worry spot for some time. What are some of the newer areas that are popping up as pressure points in the credit market?
So clearly the consumer discretionary complex has become a new worry spot. Retailers, restaurants, cruise lines, airlines, autos, anything that requires people to get out of their house and spend their disposable income is really going to be an issue in the near term. And the big issue is we have zero clarity on the longevity of the problem. So if this is a truly transitory issue where in the next 4 weeks or so we can get consumers back out and spending their money, then defaults and downgrades are probably going to be pretty immaterial. But whether that actually pans out to be the case is a really large uncertainty right now.
Yeah, Charlie, let me bring you in on that note because you focus a lot on the retailers.
Right.
And as Winnie just mentioned, we're now focusing more on the hit for consumers there. Who are you most concerned about?
Well, anybody but the very best retailers right now is going to be impacted by this. And there are no winners here. There's just degrees of losing, giving everything happening. I think if you're at the top of the food chain, and that's Walmart, Costco, Target, the dollar stores, Best Buy's in that mix as well, although they're probably going to see more impact than the rest of that universe, you're going to be okay. You've got vendor power, so if there are supply chain disruptions on a systemic basis, your vendors are still apt to ship to you because you're an important customer.
Sure.
So that's another advantage that we see at the upper end of the rating scale. As you get farther and farther down, and if they're in a competitive sector that has those guys in it, there's going to be stress.
Could this be the event that pushes some companies hanging by a thread into bankruptcy? And what impact would that have? It sounds like an obvious question, but is there any way that the credit already reflects that pricing? Or would those events just be, kind of end of the story for anyone holding bonds for some of these retailers?
This is an absolute shock to the system. And I don't know that anybody has priced anything close to this into any credit risk at this point.
So you think it's going to be worse than what the market's saying?
It's hard to say. Our macro board put out a piece this morning that is taking a first half approach, but we don't know what we don't know. It's very complicated. I don't know if there's a word more extreme than fluid right now, but it's certainly at least that. And we're taking, as a team and as an institution, we're going company by company, and we're looking at multiple variables as we assess that risk.
All right. In the moments we have left, then, is there any name that comes up to you as an example that you could buy here that you think is being overly sold? Don't
forget, I'm a fixed income analyst, not an equity analyst.
That's what I mean on the credit side of this.
I would say that the companies at the top end of the rating scale are the ones that are going to be the best positioned in this cycle.
Okay, Winnie, same to you real quickly. Do you think anybody's better positioned than the market's giving them credit for?
I think you absolutely have to be up in quality right now. If you're going to take credit risk, I would prefer to do it in the front end of the curve rather out in the long end of the curve. Generally we don't see downgrades and defaults because of near-term maturity issues. It's much more the liquidity management issue in terms of cash flows. So companies that have already locked in really cheap debt, I think, are the ones who are going to be able to come out of this the other side.
All right.